We're just over a week away from the next Fed decision. What do markets want to see between now and Fed Day? Let's ask Meghan Shue. She's head of investment strategy with Wilmington Trust. And Meghan, I think to Mike's point about, the case for a soft landing can still be made, is still intact. I even see on CNBC.com an article about how the vibe session is over, and it's almost as if the broader public is coming around to the idea that, the economic outlook might still be okay. Do you think that's the case, even as we're hearing about, companies struggling, losing lower income shoppers and that kind of thing?
Yes, Kelly. Well, I think all of the points that you're making are really important. And we are definitely in a period of some mixed economic data, which, depending on how you want to look at it, you can take almost any economic data release over the past few weeks and find something that sort of can anchor you to your prior position. That's how mixed it's been. And I think the labor market report is a perfect example of that. But we are really trying to keep our eyes wide open to everything we're seeing at the consumer. The consumer is definitely struggling in certain parts, and we're seeing lower income consumers start to pull back a little bit more. That doesn't mean that we're headed to a recession necessarily, but it's something to watch. The labor market data as well has been mixed, where new entrants to the labor force is a key reason for some of the perceived weakness. But we're also very aware that many of the economic data points that we're looking at are not necessarily leading indicators. They often start to deteriorate after a recession. But when we look at it in the totality of the economic data, we still see a solid overall consumer, businesses that continue to hire and continue to spend. And if you have those two things, then it's very unlikely that you just fall into a recession on your own accord.
Yeah.
So we are still expecting a soft landing.
That said, if we look at the market and what's doing the best here in September as opposed to maybe back in June or July, utilities are now doing quite well. Even real estate's been doing okay, and tech's gains look a little bit less exciting. So, when we talked a few months ago, I know you guys have been bullish on tech and momentum and kind of sticking with the bullish parts of the market. Do you rotate now and get defensive, or do you just say, no, this is a buy the dips opportunity?
Well, I think you rotate, but I don't think you necessarily have to get defensive. And we've actually been seeing a rotation, not necessarily over the last week, but a rotation into small cap, which is not at all defensive. And we are still overweight to U.S. large cap as well as U.S. small cap, but we're very focused on diversifying. We still want to maintain, if you're looking at just sectors, we still want to maintain a decent exposure to the tech sector, but we're also finding opportunities in staples, in real estate, in some of those other parts of the market that have been a little bit more left behind. But if you look at valuations relative to a 5 or 10-year history, given the recent weakness in tech's not looking all that expensive anymore. And you have financials, you have utilities, which are starting to creep up towards and above their 5 and 10-year multiple average. So different parts of the market becoming a little bit more interesting, but some of the defensives and some of the leave behinds have actually really increased and had some nice catch up here.